Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hi everyone, welcome to another episode of ADMAIL. On today's ADMAIL Real Estate number 4. That is the episode title of today's podcast, and this is the 4th episode in the category of real estate IRA. So today I'm going to answer and discuss 3 really important questions involving real estate and an IRA. And again, just if you haven't listened to the 3 previous podcasts on this topic on the ADMAIL feed, I strongly suggest you do. I think you'll learn a lot. Real estate is the most popular alternative asset investment for self-directed IRA investors. So that's why I wanted to do a multi-tiered approach to this topic and do multiple episodes on various questions, because I have a queue of probably maybe at this point 80 something questions, and a good chunk of them are real estate related. So I just figured it'd be easier to just aggregate them together and then just kind of flow out some episodes that deal with real estate and IRAs and kind of have fun learning from these questions. So without further ado, let's get started. First question's from Chris M. Chris wants to know, I plan on investing my self-directed IRA in a real estate deal. I read on your website about this tax called UBIT. Would it apply to this type of deal? So great question, Chris. Sorry. I answered a similar question on a previous episode, but I guess Barry, who produces this show, thought this was important to kind of retackle. And I agree with you, Barry. Very important topic. So real estate funds are obviously super, super popular investment structures where a promoter campaigns raised, where the money's aggregated by a bunch of different investors to invest in real estate, whether it's commercial, residential, flips, developments, whatever, right? Real estate, again, is the most popular asset class and very common to do campaigns, sponsorless funds to do real estate deals. So in almost every real estate deal, there's leverage. What's leverage? It's a loan, right? Just basics that you're going to be able to buy more if you're a real estate investor, if you borrow money from a third party. It's OPM, other people's money. Every real estate investor tries to employ that strategy to the maximum. So yes, there'll be leverage. Real estate funds are pass-through entities. So in order to trigger UBIT in an IRA, UBIT's an Unrelated Business Income Tax. It's a tax that was really designed and implemented into the tax code in the 50s to target charities like the Red Cross, hospitals, and they were concerned that companies would then start charities and never pay tax on sale of widgets. So they said, okay, that's fine. If you're a charity, you can absolutely get tax deductible contributions. You don't have to pay tax. But if you're doing something that's unrelated to your exempt purpose, we're going to tax you like a trust, and the maximum tax rate in 2024 is 37%. IRAs are taxed like, or tax exempt like charities, 501As. They're not 501c3s, but they're 501A trusts, meaning they do not pay tax. Unfortunately, the UBIT rules follow and target IRAs as well in 3 particular instances. 1, using a non-recourse loan to buy real estate. Number 2, non-recourse loan to buy assets like stock. And thirdly, if you invest in an active trader business, like a restaurant, through a pass-through entity like an LLC. If you noticed, I said pass-through entity. That's why when you buy Apple or NVIDIA or Tesla, you don't pay UBIT tax because they're corporations. They're boxes, not pass-throughs, not flow-throughs, not funnels. So if you invest in a real estate fund, it's going to have leverage. It's going to be passed through. You're going to have UBIT. The UBIT applies on a portion of the income allocated to the debt. So 80% debt, 80% of the net income attributable to the fund will be subject to UBIT in the hands of a retirement account. You minimize it. You can set up a US blocker, reduce 37% to 21%, or Chris, you can set up a solo 401k. Using a solo 401k, you can circumvent the rules and not pay UBIT tax because Section 514C9 has an exemption for the use of a 401k that acquires real estate. Does not apply to IRAs. Assumingly, based off the legislative history, they wanted to expand the exemption so big pension plans have more investment opportunities than you and I. But you can get in and take advantage of the exemption through a solo 401k. So very, very great question, Chris. Really appreciate it. Second question of today's podcast is from YouTube. And this person wants to know, I own a piece of land in my self-directed IRA and now want to build a home on it to rent out. Can I do that? So the answer is yeah. Okay, you can build a house. If the land is owned by the IRA and you want to use IRA money to build the home, no problem. But what you can't do is if the land is owned by the IRA, you can't use personal funds to build that home because that would be a prohibited transaction. So number one, yes, your IRA can buy land. There's only three things your IRA cannot do: life insurance, collectibles like art. Thirdly, under 4975, do any transaction that in any way directly or indirectly personally benefits you, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities 50% or more controlled by such persons. Otherwise, you can do it. So yes, your IRA can buy land, your IRA can build. Obviously, you shouldn't be the one building. Hire a team to do that for you, not related. But this is the key thing. IRA owns the land, IRA's got to own the house, okay? You can't live in the house, you can't use it. You can rent it out, not to a lineal descendant, but brothers, sisters, aunts, uncles, friends, third parties, cousins. Those are not disqualified people. Those people are kosher. You can transact with those folks. So the one thing to keep in mind is if your IRA owns the land, do not use personal money to build a house. Use IRA money, borrow money. Don't use personal money or get a loan from a lineal descendant, since your IRA is a disqualified person and your IRA owns the underlying land. Third and final question of today's podcast from Sean S. Sean wants to know, I plan on using a self-directed IRA to do a fix and flip business. Can I do that? So yeah, you can fix and flip real estate, Sean, but I wouldn't call it a business. Please don't. Why? Because if your IRA invests in a business, it triggers that UBIT tax, which I mentioned in Chris's question. UBIT tax 37%. We don't want to go there. So you could fix and flip multiple fix and flips in a home in your IRA without treating it as a business. What's the number that will trigger UBIT? It's great. Okay. There's a number of facts and circumstances the IRS will look at based off numerous tax court cases. Here's a few. All right. Your intent. Are you intending to start a business or not? Frequency. Is it 100 or is it 3? How close? What's the proximity to the fix and flip? Are you buying today, flipping tomorrow? What's the level of the improvements? Are you putting in $1,000? You putting in $1 million? Okay. Those are some of the factors. What do you do in your personal career? Are you also a fix and flipper? So this is the kind of stuff the IRS would look at if they ever targeted the transaction and try to argue that UBIT applied, whereas you would take the position it's passive, UBIT doesn't apply. 15 years of experience as a tax lawyer. I've been practicing tax law 23 years, almost 24 years. If you're under 4 or 5 in a year, you're going to be fine. Even 5 or 6, I can live with that. You're doing 8, 10, 12, you made probably a business. The IRS can argue that looks a lot like inventory, but 3, 4, 5, 6. And you can work with us. We have some ideas and thoughts and how you could, I think, do some stuff to make your claim that this is more passive than a business. So we've been doing this a long time. We have some idea that can help you. But yeah, most folks in today's day and age, 2024, this isn't 2010. It's going to be awfully hard to do 4, 5, or 6 flips in a year. It's not a lot of inventory. The deals aren't there. So I think the deals will come back, but they're not potentially there right now where you can do, so many flips in a year. So most of my clients are doing, 1 to 4 in a year. And I think you're good. I think the IRS would have a very tough time arguing UBIT. And when the IRS brings cases to tax court, especially in the IRA retirement world, they're looking for slam dunks. They don't want to argue facts and circumstances stuff. They want a slam dunk like, hey, I use my IRA to buy a house and I live in that. clear prohibited transaction. Or I took my IRA and I bought gold and I kept it at home. You violated 408M. The gold must be held in physical possession of a U.S. depository, trust company. So that's the kind of cases they're going to pursue. They're not going to deal with these facts and circumstances. Number one, there's a risk they lose. Number two, you're going to spend a lot of money to get very limited value. Potentially, it's not guaranteed. And third, it's your retirement account. It has to be a clear violation to want to basically blow it up. So, Sean, I think if you're under 5, 6, you're probably fine. I wouldn't worry about it. And I wouldn't call it a business. I would just call it a passive investment. That would be my advice. So thank you, Sean. Thanks to the individual at YouTube. Thanks, Chris. Appreciate all your questions. If you guys have more questions, send them in. Info at IRA Financial. You can say ADMAIL, ask Adam. They'll find their way in my inbox. And just keep listening, because eventually your question will be presented on the podcast. And I love it because these are great questions. I got super smart people. And again, you don't have to be a client. I just need your email. That's it. Just send in an email. I don't use anything but your first name and the first letter in your last name. This way it's privacy, anonymity, it's confidential. You don't have to worry. I'm not going to spill the beans if you're doing anything potentially prohibited. It's not my job. I'm not the IRS. I just want to help people, educate people, and help navigate the IRS rules so we all can be smarter, wiser, and richer IRA investors. So thanks again for hanging out with me today. I hope you guys enjoyed the podcast, and I'll see everyone again next week. Take care.